Depending on when you bought it, Bitcoin is either the best investment of your lifetime or a painful reminder of buying near the top. Bitcoin hit an all-time high of over $126,198 in October 2025. Today, it's trading around $81,000. For the person who bought at $126,198, that's roughly a 36% loss. For the person who bought 5 years ago at $10,000, that's still a massive gain, as Bitcoin is roughly $81,000 today. The market cap is now about $1.33 trillion. The question is, what happens from here? Today, we're going to approach Bitcoin the way it deserves to be approached, with data, with honesty, and without either the uncritical hype of the bulls or the reflexive dismissal of the skeptics. This is Potentia, and this is Bitcoin in 2026. The most important thing to understand about Bitcoin in 2026 is this. It is no longer a retail phenomenon. It is an institutional asset class. Spot Bitcoin ETFs, exchange-traded funds that hold actual Bitcoin and trade on traditional stock exchanges, have now been live in the United States for over 2 years. In April 2026 alone, these ETFs registered a record-breaking $1.97 billion in net inflows. Total inflows since the product's launch have now exceeded $58 billion. Major banks, hedge funds, pension funds, and sovereign wealth funds are now allocating to Bitcoin as a legitimate portfolio component. This is a structural shift. It changes the supply and demand dynamics of the asset permanently. When institutional investors allocate to Bitcoin through ETFs, they are not speculating on a chat forum. They are making deliberate, risk-managed portfolio decisions, and they are buying consistently through volatility as part of a long-term allocation framework. The implications of this are profound. Bitcoin's volatility, which has always been both its most attractive and most frightening characteristic, should moderate over time as the institutional base grows and market depth increases. The asset is maturing, slowly but unmistakably. Let's lay out the bull case clearly and honestly. The halving cycle. Bitcoin undergoes a programmatic reduction in its new supply, called a halving, approximately every 4 years. The most recent halving occurred on April 20th, 2024, reducing block subsidies from 6.25 Bitcoin to 3.125 Bitcoin. Historical data shows that Bitcoin has entered its strongest price appreciation phase in the 12 to 18 months following each halving. By that timeline, the window of peak potential performance runs from roughly mid-2025 through the end of 2026, and we may still be inside that window. Indeed, Bitcoin reached its all-time high roughly 6 months after the halving, which is consistent with prior cycles. Regulatory clarity. The United States is moving toward comprehensive cryptocurrency legislation. The Clarity Act, the Digital Asset Market Clarity Act, which would create a clear regulatory framework for digital assets, advanced significantly in 2026. As of May 2026, betting markets give a 67% probability to the Clarity Act passing in 2026. Resolution of regulatory uncertainty is a meaningful catalyst for institutional adoption. When the rules are clear, the large pools of capital that have been waiting on the sidelines can enter. The inflation hedge narrative. With U.S. government debt now exceeding $38.98 trillion, with inflation running above 3.88% in the CPI annual estimate for May 2026, and with central banks around the world having expanded their balance sheets dramatically, the appeal of an asset with a fixed maximum supply becomes more intellectually coherent. Bitcoin cannot be inflated. Its supply is capped at 21 million coins, forever, by mathematics. In a world where governments can and do print money, that scarcity has a value that is increasingly hard to dismiss. The institutional bid. Grayscale, the world's largest digital asset manager, stated in April 2026 that Bitcoin has likely already hit its bottom in the $65,000 to $70,000 range. When the largest prof. Now let's be honest about the risks. Because Potentia doesn't sell you narratives, we give you the full picture. Bitcoin remains extraordinarily volatile. It has declined 80% or more from its peak in 3 separate instances in the past decade. Anyone who tells you that can't happen again is not being honest with you. The regulatory environment, while improving, is not fully resolved. A hostile regulatory development, a ban on Bitcoin ETFs, aggressive taxation of crypto gains, or a major exchange collapse could trigger significant price declines rapidly. And competition from other digital assets remains real. Bitcoin's dominance of the crypto market has oscillated significantly over the years. The emergence of a better designed monetary asset is not impossible, even if many experts consider it unlikely. Here is Potentia's honest framework for Bitcoin in your portfolio. Treat it as a speculative allocation, not your core position, not your retirement fund. A defined percentage. For most investors, somewhere between 2% and 10% of investable assets, sized so that if it went to zero tomorrow, your financial life would not be destroyed. The investors who are winning with Bitcoin right now are not the ones who went all in. They're the ones who sized it correctly, bought through the volatility, and have the discipline to hold through the drawdowns. That's not exciting, but that's what actually works. Bitcoin is not for everyone. It requires a tolerance for volatility that most investors genuinely don't have, and that's okay. The best investment is always the one you can stick with through the difficult periods. But for those who understand what they own, why they own it, and how much of it they should own, Bitcoin in 2026 represents an asymmetric bet on the institutionalization of digital assets at a moment when the infrastructure, the regulation, and the capital flows are all pointing in the same direction. This is Potentia, where power needs no introduction. Until next time.